If this is the first time you've joined one of these sessions or you don't know a lot about me yet, you might have started copying recently, so just a little bit of background information about myself. So my name is Reinhardt Coetzee. I'm from Johannesburg in South Africa. So my line of work is in industrial automation. Specifically, I specialize in data analytics. That's kind of my qualification as well. So I'm a qualified MCSE, MCSDBA, and everything like that in Microsoft Technologies, specializing in big data analytics solutions. So my focus in my consulting career has always been in industrial automation, and more recently you might have heard the term Industry 4.0. So it's all around technologies like IoT, big data, and how to leverage that for corporations and making sense of getting value out of those new technologies. So it really does give me an edge, I think, in terms of investing as well. So I think like at least like 60-70% of the companies in the portfolio is actually products that that I either use on a day-to-day basis, or specifically when you look at those software as a service companies that I use in my consulting work, in terms of researching those companies for implementing those solutions and products into these products, into these projects. So I really think it does give you an edge, when you start researching these companies from a different perspective. Not just from a traditional investing perspective. You look at valuations like at PE ratios and all those kind of things. We start looking into it from a consulting project perspective, and you start looking at things like, what do developers think about these products? How easy it is to do business with these people. So from all different kind of angles, you start looking at things like what the approval rates of the companies, how people enjoy working for these companies. I think it gives a completely different perspective on these businesses that we're investing in versus just the ticker symbols that you see flashing on the screen with the values that are changing on a daily basis. The portfolio is really all about long-term investing, technology specifically orientated growth stocks, and we'll get into a lot of that in the presentation. So that's just a little bit about me. You're welcome to connect with me on any one of those resources you see there. You can have a look at my YouTube videos, or connect with me on LinkedIn, or have a look at my website for a little bit more background details about me. So what we're going to cover today is just my kind of like outlook on the market, where we are at the moment. Kind of do a comparison of what we did previous quarter when we did one of these videos. So if you didn't join that one, you can catch that up on my YouTube videos. But really today I want to look at what's going on now versus what we looked at a quarter ago. So when we did this, I think it was back in May, beginning of May, things were looking a little bit different. Tech stocks had really just taken a little bit of a beating, as we saw a cyclical shift into more value-orientated stocks. And really the whole conversation for the first part of this year, the first half of this year, has been mainly around inflation and the effects of that on the market. So if you look at what inflation looks like, I think a lot of us have heard the statistic of seeing this kind of thing, and it looks a bit scary. So CPI, inflation consumer price index, was about 5.4%, so it's gone up pretty high. There's a lot of talk about how to look at this because of obviously the reopening of the economy. Commodity prices have skyrocketed, but it's also now subsequently come down quite a bit. So a lot of what's been happening in the market has really been dominated about what the Fed has been doing in terms of their stance, and will they be changing inflation rates to interest rates, to compensate for inflation. So a lot of the comments from their meetings and notes have been that it's the inflation we're seeing so far is very much a transitory thing because of last year's lockdown. That these kind of inflation that we're seeing now is not going to be long lasting. But it's one of those things nobody really knows, and we'll have a look at that and see how that impacts us as well from a portfolio perspective. But just in general, why this might be bad for a portfolio like ours, or technology or growth stocks in particular, is it can make growth stocks look a little bit less attractive, because mainly growth stocks, technology stocks, are valued on future earnings. So if inflation goes up, and normally you see interest rates also accompanying that and going up as well, which means it erodes that future value of money, which means those future earnings is not as worth as much anymore for those growth companies, versus if you look at value stocks, which is now kind of gotten into more popularity this year because of inflation. If you look at value stocks, they're typically more priced at their current intrinsic value, which should mean that they shouldn't be affected by inflation as much. But again, there's always a counter argument about all these things, and then as we'll see as we go into it, the big thing about these kind of things is it's all about long-term investing. You look at all these macroeconomic factors, whether it's inflation, whether it's these black swan events like COVID, whether it's like the yields that people look at all the time in terms of that 10-year yield and trying to time the markets. It's really just about long-term investing in good quality businesses, and that's how most people really get long-term success in the markets. If we look at that 10-year treasury yield just as an indicator, I thought I'd just look at this. A lot of people, like I said, obsess about this. So when we looked at this back in May, you could see the yields going up after they've been coming down for the longest period because of the interest rates coming down, indicating that there was an expectation for interest rates to go up again to curb this inflation. So a lot of the comments we've heard from the Fed now recently again is that they will not be looking at pushing up interest rates higher anytime soon. But people are still skeptical about this because of inflation. They might have to change that stance sooner rather than later. Interesting to note from that period to now, you can see the yield is actually coming down again. So it's almost like the bond market is pricing in interest rates not going up, not for the short term anyway. So we talked about value stocks versus growth stocks. So if you look at these two, these are two ETFs that you can find on eToro as well that kind of tracks that S&P 500 specific indexes, the value index versus the growth index. So looking at value stocks versus growth stocks, or versus looking at those cyclical stocks like commodity stocks that typically do well in a recovering economy period or high inflation period, versus growth stocks. So if you look at that, it's actually value stocks has come into more prominence in the beginning of this year, but as you can see in the chart, actually growth stocks just started to overtake it again during this year. So again, it's one of those, nobody really knows what's going to happen in the economy, and anybody that tells you they know for sure will definitely be lying. But it is interesting just to keep these kind of macroeconomic factors in mind when we do invest, specifically in terms of how we handle volatility and the risk to the portfolio, which we'll also get to in a second. So if you look at this chart here, this kind of tracks inflation since 1986 and overlays that with the NASDAQ 100 index. So it's kind of like my benchmark. It's a very technology-orientated, growth-orientated index. So just for reference, if you look at that, over that long period of time, you can see those areas shaded in green is where inflation is picked up by more than 2%. So what you'll notice is there's not a lot of actual correlation between that performance of that index versus inflation. So when inflation was rising, the index was rising through those periods, and subsequently also when inflation was dropping, you still saw that index rising. So you'll also note that after some of those periods of high inflation, you also saw a contraction in the index or in the stock market in general. But those were more to do with events leading up to a pullback in the market versus inflation actually forcing the market. So if you look back in March 2020, you can see the pullback there in the index, falling a bit sharply there, and obviously inflation coming down as well because of the pandemic and everything closing down. Obviously the US pumping a lot of money into the system, dropping interest rates to near zero. But that wasn't as a consequence of inflation running hot. It was more because of other events happening that forced inflation down. I think the key takeaway there is just, inflation on its own is not really a really good indicator for performance when it comes to growth stocks. Growth determines the value of growth stocks, and I think the value of the stocks in our portfolio is really the growth stories behind them. You'll see something that has happened, I think, is definitely the market is starting to pay attention a lot more to growth stocks that actually have a valid business case, fundamentals behind it, actual revenue, actual growth prospects, solid businesses with a good solid strategy, versus some of these high-flying tech stocks that we saw in 2020 that just, the valuations just got skyrocketed and without really substantial fundamentals behind it. So I think the market is getting a little bit more selective in terms of those stocks, but the majority of the stocks in our portfolio are like, the Spotifys, the Amazons, the Microsofts, those big growth leaders. It's got fundamentals behind it and a lot of growth still looking forward. So just the terms of that volatility and how we position the portfolio going forward to counter some of that volatility, you can see that's the volatility index for this year. So you can see there was a huge spike during the beginning of the year, and it's calmed down a little bit now, with the volatility just picking up there right towards the last week. We had this really volatile day the other day, like 2 days ago, I think on Monday. So how we cater for this in terms of the portfolio is really something I wanted to focus on today as well, is adding cash or having that cash component of the portfolio. I know I've had loads of questions from people asking me, we had I communicated quite a bit a while back after tech stocks dropped a little bit during the beginning of this year when we added some funds to the portfolio, which is not ideal because it does disrupt a little bit in that copy syncing and everything. So we try to minimize that as possible by not adding cash too often. But it is important, and I thought it was a good time to do it. I think it's one of the key metrics for success in investing in long term is adding cash to the portfolio. So I'd recommend, whether it's copying me or however you do it in terms of investing, it is a good idea to have a strategy in mind in terms of adding back into your investments over time. So back to the cash position, why that's so important. So a lot of people are asking me, so what are you doing with that extra cash that we added? So in short, we didn't do much with it. By the time we added that additional funds, growth stocks, tech stocks have already been started recovering quite quickly. So we are again kind of back to all-time highs where we saw back in February for a lot of the stocks. So I think a fantastic position to be in right now is having that cash in the portfolio, and that's what I really wanted to try and get across today. Is it's not that cash is sitting there doing nothing; it's playing a vital role in the portfolio. So typically, I always try and maintain between 5 and 20% of cash in the portfolio. So just because it shows as uninvested doesn't mean it's not doing anything. I think that's the important thing. So the cash is there for a reason. It kind of buffers against this volatility. So where the market was a little bit less volatile, it's kind of nice to go all in, 100% invested. But in terms of times like this, where the market starts to show some uncertainty about how it wants to value some of these companies, which can lead to a lot of volatility, it's good to have a little bit more cash in the portfolio. So it just buffers and dampens that volatility a little bit, but also obviously it allows us to have that cash in the portfolio, and it's immediately available to be able to open up some more positions into stocks that have dropped quite a bit. And we'll have a look at some of the examples later as well, how that have greatly benefited the portfolio in the past by adding to our positions when some of these stocks do drop, because inevitably growth stocks are a little bit more volatile, and they do go through dips and ups and downs. So a little bit more in terms of adding that cash. Whenever you want to have a look at the cash balance in the portfolio, if you just go to my portfolio and you scroll right to the bottom, it will show you the balance. So you can see there at the moment, after adding that cash a couple of months ago, it's now sitting at 17.47%. So I think that's a really good position to be in. So I just wanted to show, so a lot of people are also asking about how to check if they've got the same percentage-wise. So the easiest way to do it is just if you go to my portfolio in your portfolio and you say remove funds, it'll show you how much you can actually remove of that uninvested fund. So again, I would recommend not doing that, because then you wouldn't have that cash position in the copy and wouldn't match 100% of this portfolio strategy. But you can have a look at that and then divide that number by the total value of the copy to give you a rough estimate of the cash percentage, and you can adjust it according to that. So I also just wanted to show for the last month or so, a couple of months actually, I think the minimum copy amount that I've always recommended was 1,000. Before that it was 600, and I'll show you it's not an ARB number. There's some reasoning behind that. I always recommend copying open trades, so it splits whatever you add to the portfolio over all those positions, including that cash position. So after, from now on, when everybody wants to add, funds, whenever, even if I don't, which I'm gonna, for all those reasons I mentioned before, it just causes a little bit of disturbance in terms of that copy syncing. So far as possible, I won't be adding any more cash to the portfolio. But for anybody copying, to follow that rule of, adding back into your investments, if you wanted to, my recommendation is always to add that minimum amount and select that copy open trade, so it spreads that across the whole portfolio, including that cash, like I said. So if you added another $600, 17 point something, that 47% would go into that uninvested portion to keep the copy in sync. So I thought I'd just quickly cover this. So I get a lot of questions around this, to just give you a little bit better understanding. Why is it so important? Why is that minimum amount there? So if you look at that copy ratio and how it works in that whole copy trading system. So if, for example, I've got, just as an example here, 94,000 in my account, and that's not the value of my account, that's how much I've invested. So obviously with all the open trades and profit not realized, that doesn't count that. So it's just how much money I've put into my portfolio, into my account. So it would be the same as how much money you invested in the copy of me. So that gives you that copy ratio. So if you look at that example, that would give you 188 to 1 copy ratio. So that just simply means if I open a trade in, let's say Apple, for example, of $200, you divide it by that copy ratio, and that would open a copy trade. If you looked at my copy in your portfolio, you'd see that same trade getting opened, and it would open at $1.06. So the reason why I changed it to $1,000 recently is because eToro, for a brief time there, they changed it so that the minimum trade size that could open went from $1 to $2. So you can see immediately the issue there. If you copied with $500, that trade wouldn't open. Existing trades also wouldn't open that I've got open at $200. So I'm also trying to phase out these smaller trades so it becomes less of an issue. So if I just look at this next one, so there, for example, if a trade size is $300, the copy trade would be $1.59, so it would be less of an issue. It would be way over that $1 trade size minimum. So eToro changed that back to $1 from $2, so now it's not an issue. So I don't want to get too technical about this, but that is just the whole reasoning behind why the minimum amount is there. And just again as an example, so the other way around, if I added more cash to my portfolio, that copy ratio would again change. And if you just copied with $500, you could see the issue there. It wouldn't open any of those $200 trades. So my recommendation is the $600 because I'm not planning on adding any more cash anytime soon. So in general, all those $200 trades would easily open with $500, but just to make safe and give it a little bit of breathing room, my minimum recommendation is $600 there again. Right, enough of that. So just there in terms of when I've added cash to the portfolio, you can see it hasn't been that often during 2019. I did it twice in 2020 when we saw the start of the pandemic and the markets dropped, added some cash there, and that obviously boosted performance. So like I said, I'm going to try and not do that unless it's really necessary, just to make it easier for everybody copying. So, but I would recommend, having that kind of strategy in adding into your investments over time. So let's have a look at portfolio performance over the last quarter. You can have a look at the fact sheet. I always recommend doing it like this. So instead of just looking at it on a day-to-day basis, where it can be a little bit scary as the market moves and you go through these volatile times, it's always better to just take a step back and look at something like this fact sheet. And the link is there at the bottom, and it's also on my bio on my page. So this is eToro, just kind of giving you a fact sheet, a performance kind of sheet of my portfolio on a month-to-month basis. So you can see there, if you look at it like that, it's still doing really well, even though this year has been very bumpy and hasn't been the best year so far. But if you look at it over that period of time, you can see why long-term investing is such a crucial thing, rather than focusing on a day-to-day or even on a month-to-month basis. But looking at it like this makes it a lot easier and puts it a lot more into context. So you can see we're easily outperforming the S&P 500 there by quite a margin. So if you look at the total return statistics, so you've still got, as we are here today, we've still got, since started on eToro, it's an annualized return of 34% versus 17% for the S&P 500, and a total return there of 340% versus 102% for the S&P 500. So I'm really still very happy and optimistic about the portfolio and where we are and where we're going in terms of the performance. So I showed this last time as well. It's just, since I've started investing in 2006, there's a lot of noise out there, and the important thing is really to try and focus on the signal. Over that time, there's been so many different events. It's like on a weekly basis, there's calls for market crashes. There's calls for, collapses in the economy, or why, why the stock market is about to crash. You see these kind of these kind of news events on the CNBC, and people talking about it all the time. It's funny, I told myself I wouldn't, but I couldn't help myself. Started watching a lot of Jim Cramer on CNBC. I don't know if you guys watch it, but it's funny watching him watching him on a month-to-month basis. The 1 minute it's like, you should do this because the economy is like this and it's all about inflation. And then if you watch him a month later, it's almost the opposite. So even somebody like him, which I have a lot of respect for, because what he's saying does make a lot of sense when he talks about companies and interviews these CEOs. It's a very interesting show to watch. But you can see the time frame there is still like very short term. And that's typically the thing that you find with, when you look at a lot of these analysts and the things that they come out in these news articles. It's scary, but it's really because the focus there is a lot more short term. So if you really focus on long term investing, you can block out all this noise. It'll always be there. The main things to focus on, again, is to invest in quality businesses and have an ownership mentality for those businesses over the long term. Just in terms of also the portfolio positioning and where we're going, so I always like to look at it like this. There's quite a few stocks in the portfolio now, like 50 or 51 positions in total. But if we split it up into these kind of market themes, I love looking at it like that way. So for me, it's all about these kind of different sections within the portfolio. So focusing on my main overarching theme is artificial intelligence, which I think is going to be a driving force for many of these companies, or everything in terms of our day-to-day lives and how these companies perform in the future. But it's a really subjective thing. It's difficult to quantify exactly how that will relate to performance on stocks. There's companies that do AI and provide these kind of platforms, like your Googles and Amazons and Microsofts. But fundamentally, almost every single company in the portfolio, to some extent, is using AI. And it's how they start using that AI that really differentiates that business model and business value that I think is going to be a huge growth factor for a lot of these businesses. So it's like kind of like an overarching theme in the background for all my stock picks. But within that, there's also the different themes. So if you look at the fintech companies or streaming companies, cloud software service companies, or the semiconductor space, it's a big issue at the moment with the chip shortages and things. Cybersecurity, I think I actually want to do this next time. I actually want to put the numbers to each one of these themes. I want to run the numbers and actually see how these different themes are performing. If you look at those pockets, those buckets of stocks, it'd be quite interesting to see. But I think cybersecurity is one of those that's really going to take off as just everything moves more and more digital, and companies have to protect their businesses. So it's interesting looking at that way, and I really think the portfolio is really set up really nicely to capture all the benefits of where we're moving to. So like I said again, there's going to be a lot of noise and there's going to be volatility, A lot of these stocks are definitely on the higher end in terms of valuation. But if you look historically back into companies like Amazon, that's been, these disruptive forces in the markets, their valuation has been consistently high, and it's been consistently a valuation that the mainstream media would say is, way too expensive. But I think it's these kind of companies that's really got the edge in terms of their business models. And like I said, I'm really still excited about the positioning of the portfolio and the benefits that these companies will realize in the future. So if we look at the portfolio weighting, this is from a quarter ago. So just to do a comparison again, we can see the biggest position there is Shopify. If we look at it now, if we put cash as a position in the portfolio, you can see that now makes up our biggest position in the portfolio. So I wanted to show it this way so you can almost see how cash is almost just not this thing that's just there that's not being used. It's actually a position in the portfolio playing a very important role, buffering against that volatility and everything. So like I said before, it really plays a very important role. Besides, if you take cash out, Shopify is still our biggest position, and it's interesting actually to look at Shopify's performance this year, and I'll show you an example of that. And same goes for a lot of those big positions in the portfolio. So you can see also those bigger positions portfolio really make up, and that goes back to where I showed the slide between those core positions and the growth positions versus how much we've got in cash. If you look at, even though there's a lot of stocks in the portfolio, it's really the top 20 stocks that makes up the majority of the value of the portfolio. I showed this last time as well, just a quick thought again on long-term investing. So, if you look at that total time span of the portfolio, while it's been on eToro, it's been a really good performance, but there's been lots of volatile times in between. So I just highlighted this again. So if you started at the worst possible time and you copied around about that September in 2018, you would have lost about 25% in value and from top to bottom. And that would have been rough, and definitely I would have lost a lot of copiers there, but it's I always try and drive this home that the portfolio is really about long-term investing. For these companies, it really takes some time to execute on their vision. A lot of the more younger growth companies especially, and they tend to be very volatile. And typically what you'll see is whenever there is times of uncertainty in the market, whatever that uncertainty, driving force behind that uncertainty is, if it's inflation or if it's these other macroeconomic factors, whenever there's this uncertainty, the biggest sell-off you will see will definitely be in the growth space, just because of that valuation being higher. So whenever something like that happens, those are the first stocks to get sold off in people's portfolios, and the big funds out there and the big hedge funds out there, which will drive the price down. But that's short-lived, and over a longer term period of time, it definitely far outperforms the general market as well. But it is important to keep that in mind when we go through periods of volatility, that growth stocks will be volatile. But if you can be patient and you have that right mindset, it is very rewarding if you can just hold on for the long term. So just as an example there, that was the absolute worst point since the portfolio has been on eToro to copy. It would have been very tough to have started copying there and hold on, having to see that 25% drop. And it took about 6 months to recover back into where you would have just been, back to zero. Since then, if you had copied there, you would still be up 128%. If you started copying at the absolute worst time, you could have started copying. So obviously, hopefully, I never try and time it. And I always recommend, people always ask when's the best time to copy, start copying. And for me, it's just, just starting is the best time, and adding to your investment. So my best advice also, if you want to start with a lump sum, break that lump sum into equal parts and decide how many parts you want to invest in equal time periods as well. So you can just start getting into the market and add to your investment. And that will also buffer whatever happens in the market in the short term. Just a quick look at some of the stocks in the portfolio and how they've performed this year so far. So you can see the best performance there on the left-hand side. We've got Google, HubSpot, Nvidia. And then on the right-hand side, some of the stocks that haven't been performing so well. So right at the bottom, you can see Fastly, Unity Software. So this is just year to date. It's not how the stocks have actually performed in the portfolio. Some of the stocks we only added later in this year. I think a company like Unity Software, I think it's not nearly like that because we only added it after that drop. But it just gives you an idea of how the stocks are working themselves through this period of a little bit of uncertainty and a little bit of uncertainty in the market and how to price these stocks. A lot of that has got to do with how these stocks ran up in 2020. So if you look at some of those companies at the bottom there on the right hand side, companies like Teladoc Health, for example, saw massive gains in 2020, and we saw some of that sell-off now in 2021. Just highlighting Teladoc Health because we'll have a look at see why those companies, why do we keep these companies? And it's so important to keep those companies if we still believe in them and the business case is still there, not to just sell them off because they've lost a little bit of percentage-wise. The underlying business is still 100% the same. It's more in terms of just the market, in terms of valuation, people selling it off, but nothing's changed in the business case and business value. And those tend to be the biggest winners over time. So to illustrate that point, I showed you this last time as well. So if you look at our biggest holding, Shopify, at the time in May, you could see Shopify had come off that all-time high, and I showed you this tear-down chart. We looked at the actual earnings, the previous earnings release. So Q2 earnings is now coming up for Shopify as we look at the earnings season coming in now for tech stocks. But we looked at the previous earnings at that time, and my thought process around that was, if you looked at the earnings report, Shopify was doing incredibly well. It had outperformed on every single measure and metric that you could imagine, that you could look at. But yet it sold off by like 20%. And really it's just again because of that high valuation and investors trying to figure out what a stock is worth, and a growth stock like this, what it's worth in terms of that valuation. So we saw this 20% sell-off. And what I showed you was this kind of tear-down chart with some of the biggest growth stocks in history. You'll always see this. You get this periods where a stock like this will sell off by 20, 30, maybe even 40%, and it happens quite frequently. So if you look at that first chart, it looks like it looks like every investor's dream. Sure, the chart's up and down, but over a long term, it looks fantastic. If you look at a chart like this way, it looks a little bit more chaotic. But it's a good way to just have that mindset about how these kind of stocks tend to perform in the short term. So you'll see this jumps up in volatility from at an all-time high at this chart, an all-time high is at 0%, and how that stock will fall off from that all-time high. But inevitably, if it's a strong, solid business with a good business case, quality leadership, quality products, these companies tend to hit the next all-time high. So it was interesting just to do a comparison. So this is what I presented last time. So argument for keeping with these companies, actually reinvesting into these companies. So if you do add some cash in the portfolio, using some of it to actually add to these companies, that's dropped a little bit. So if you look at Shopify where it is today, you can see it has indeed now reached again an all-time high. And obviously if you look at that teardown chart now, we're at, again, following that kind of pattern where we're at now at a new all-time high. So it's just an interesting way to look at it. It is inevitable. These companies do go through these ups and downs, but good businesses tend to keep on performing well over time. So I also showed you this time. So these are some of the real laggards in the portfolio that was beaten down the most when we saw a little bit of the tech sell-off. Companies like MongoDB, Teladoc, Trade Desk. A lot of the issues around specifically companies like MongoDB and Teladoc was the fear that it was more of a 2020 kind of growth story, and then when the economy started reopening, companies would start, Teladoc Health, for example, that specializes in telemedicine, wouldn't see that same growth. If you look at the earnings reports for a company like Teladoc Health, again, Subscribers on their platform has actually grown. It's actually more than it's ever been, even in the height of the pandemic. So there's a lot of growth left in the company. It's just, again, that valuation issue and investors trying to figure it out. So inevitably, a company like a Teladoc Health, the chances of hitting an all-time high is, again, very good. So just to do a comparison again from then to now, you can see two of those companies already have recovered quite a bit. Teladoc Health still struggling there a little bit, but like I said, these are the companies that I think really, if it's a good solid business case and you understand the fundamentals, where a lot of other people they buy into these ticker symbols. Like in 2020, it was a hot stock to own, but then they drop it again afterwards as soon as it drops off by 10 or 15, 20%. The goal really of long-term investing is sticking and partnering with these businesses, and that's really where I believe gives you that real success in the market, that real wealth building kind of success, and adding to these companies. Okay, so that brings me to the end of the presentation. We'll go into some Q&A, but just quickly, I'd just like to share this with you every time. So just some core things around how to manage the portfolio. So there's no leverage involved in the portfolio. So all the gains achieved is, without using any leverage. So it's just simply buying and holding these stocks, hopefully picking the right positions, picking the right stocks, adding to those positions at the right times, and just sticking to this business, researching and staying with the right businesses. Single position, not taking up more than 10% of portfolio. So a lot of people ask me, when do you sell? So I generally don't like to sell, but if one single stock does really outperform to that extent where it takes up more than 10% of portfolio, then we'll take a little bit off of that and reinvest in some of the other stocks. But in general, though, for me, a really good point here as well is what you see a lot of people do is the stocks that are really performing well, stocks like Shopify and Roku and the Trade Desk and Nvidia, stocks like that, they often sell off from those positions and add them to the positions that have lost a lot of value. And for me, the reasoning really behind this, and if you go back in history and the stats, shows that those really winning businesses tend to keep on winning. So I'd rather be adding to those successful companies rather than punishing. Why would you punish a company that's doing really well and invest in companies that's not doing well? So again, it's just a little bit of a different way of thinking about it. Keeping at least 5% cash, I think we've covered that. So I think we're really in a good position with the cash position we've got, and I will be looking at using some of that cash in adding to some of those companies. Just a note on that as well, I think a lot of people ask me, why haven't you used some of that cash? I think, again, if you have a long-term view, it's been interesting just to see how the market has been playing out from last quarter to this one. Sometimes the best thing to do is to do nothing in a portfolio, and it might be a little bit boring if you don't see a lot of trading activity happening there, but I think that's with purpose. If you take that long-term view, sometimes you have these periods where it is just the best to boring investing is actually the best way to do it. That last point as well, like I said, I'm going to try not to add too much cash in the portfolio going forward, but I think it's always a good idea for copiers or whatever you're investing in to add during downturns, especially if it's a good business, good investment that you're putting your money into. Then just lastly, some of the keys to success is, like I said, I invest in companies with an ownership mentality. We're really partnering with these businesses for the long term. Patience is key, having the right mindset, being mentally prepared for these inevitable pullbacks, keeping that mindset long term. It's impossible to predict what's going to happen in the market in the short term, but it is easier to predict where these companies will be in a 5-year period. It's not to say we have to wait 5 years to realize and see some of those profits, but it is just a good way of thinking about it. That these companies over, where will some of those market themes like AI and cybersecurity and cloud businesses, where will that be in the next 5 years when you see this noise in the market about, fears of valuation in those companies. So yeah, that's all I have for today. I hope it was interesting and not too boring.